Hey everybody, it's Justin Gartman, a wealth coach here at BetterWealth, and today we are going to dive into a fun example of a story here of a guy that he wanted a policy to look at doing a fun side hustle of actually flipping golf carts. So he's going to look at how a practical example of taking the money in a policy, borrowing against it, leveraging it to do something with. And in this case, just happens to be, I know you've seen a lot out there about buying cars, but how about this about buying hundreds of golf carts actually? So this is what the guy was, 50-year-old. He was semi-retired. So his name was Scott, and he was a golf course superintendent. So picture this story. He had worked at a golf course his whole life pretty much, got out of doing that, currently worked part-time, doing a few things here and there, but on the side saw that there's an investment opportunity for him where he actually buys the old golf carts that eventually any golf course decides, hey, here's the golf carts, we're going to get rid of these, we're going to get brand new ones, especially nicer golf courses. They want to keep the golf carts nice. So those are still plenty fine. You can buy those in bulk. He's going to buy those, fix them up if needed, and then sell them. So obviously not something everyone out there should do. He had the connections. He knew what he was doing in that. And so that's what he wanted to do. And this is how his investment went. So how it can go for him is buy a golf cart around 3,000, have about $1,500 in maintenance, transportation to get the golf carts to you, store the golf carts because they got to go somewhere. So all in basically investment of $4,500 per golf cart. And then generally he was getting $6,000 to $7,000 every time he would sell one of them. So could be six, could be seven in our examples, and everything as we project out, 6,500 is what that's going to be. So quick example, quick math here, and keeping it pretty simple. You buy 10 golf carts, that's $45,000 you just spent. You sell them for a total of $65,000. Well, you made $20,000 in profit after paying to get them fixed up, store them, and then sell them and all of that stuff. So that's what kind of the gist of what he was doing. And he liked that idea. And now obviously 10 golf carts, if you look at that, you may think that's a lot, but in the grand scheme of how many golf carts a actual golf course has, that's not nearly as much as what he could buy. He could buy 20, 40, 50 if he really wanted to. And so his predicament that he was in, if you want to call it that, is that he had some money sitting in cash, but he liked his money sitting in cash. He didn't want to have to use the money. He just liked having it there, knowing, hey, it's there, it's an emergency fund. And he had thought about, hey, knowing that I'm going to buy these golf carts, it will take him a little bit of time to sell. Typically could take up to a year, maybe slightly longer for him to sell out every single one of them. Maybe not at 10, but if he decided to buy 30, it's just going to take him some time to do that. And so he thought about getting a standard traditional loan, a personal loan, go to a bank, be able to get that. But his problem was, and why he didn't like that, well, he would have to pay monthly payments, principal and interest back every single month. And he may not be making a profit for, by the time he gets them, could be a couple months before he even sells one. And then by the time he sells all of them, he's going to be sending a lot of cash flow, potentially even out of pocket, to the bank there during that time. He also thought about maybe getting some type of business line of credit, but honestly, he was doing this on the side. He wasn't wanting to start a business, have to show income from the business and all of that stuff. He just didn't want to go through the headache. Again, he's semi-retired. He likes this. It was simple for him to do. So he didn't want to have to go through all of that hassle is what kind of the way to put it. Now, is that a hassle for everyone? Sometimes it makes sense, but for him, not something he wanted to do. Also, I know the option of a HELOC. Hey, you can borrow against your house. He didn't want to do that. He said, hey, that's my house. I don't want to have that. I'd also like to be able to build something at the time. And so stumbled across us, like the idea of life insurance, because at the end of the day, through discussions, it turns out he didn't have hardly any life insurance at all. And the more we discussed, he's like, yeah, I have a wife that, if something happens to him, leave a legacy, leave a death benefit there, have kids, be able to pass something on there. And so basically at the end of the day, what started off as he wants to get a policy because of, hey, I can have a unstructured loan. I can borrow the money, not need to pay anything back until the end of the year to pay off the interest if you want to, or could let it roll into next year if you wanted to do that. but would have the unstructured loan, the flexibility to be able to pay it back when he wanted to and not be on the hook every month for that. And so that's what led him to life insurance. And then the more that he researched, as a lot of people do, find out, oh, there's other benefits as well. Obviously, the death benefit because it is life insurance. But the more he thought about that, the more he liked that once he saw, oh, I can still get the cash value and have a growing death benefit. And then also creditor protection, all of the other good stuff there. He just liked the idea of that. So it wasn't necessarily just the one reason. It's what led him to that. And then the multitude of reasons ongoing there. And so at the end of the day, here's an example of what that would look like here. And so what he decided to do, because he was sitting on about $150,000 in just cash savings, some of that in a brokerage account, kind of in liquid places, not in his retirement accounts or anything like that, because he didn't want to necessarily touch any of that. So he started off with a $75,000 just dumping. He's, I'm going to take 75, I'm going to put it into the policy, and then he's going to wait until there's an opportunity, because it's not like golf courses are getting rid of carts all the time. He needs to have the cash when there's an opportunity, especially with his connections. Tell those, hey, you can call me first and I'll take some of your inventory or all of it, depending on what it would look like there. So started with 75, just get the policy going, have it in there. And then each year he was already saving a good amount of money, but wanted to do 50,000. Part of that was some he was already saving that was just going in savings. But also part of that was he said, hey, I like the idea of this. I want to build up a death benefit. So I'm willing to put a little more money towards this. And also he knew, based on profits, based on what he thought he could do, he's going to be able to have not only some cash flow to get from the policy, but from the investment that he makes in selling the cards, he'll be able to actually pay some of the premium back into the policy as well as pay off the loan. So quick example here of our year two, actually, let's do the 10 golf cart route. He pays $45,000 for those, borrows against that. Obviously, he has a loan balance there, so needs to pay back $47,000. So he borrows that, can sell those throughout the year. And I show here nothing being paid back at all until the next year. And that's where you see this premium outlay now. Here, he's doing 75, funds at 50, borrows against that. So his cash value goes down. He's still earning, though. That's his net cash value that is available. But remember, he's still getting a dividend and getting growth on everything that is in there. And so now next year, he pays back that 47,000 plus adds another 50, just like he was planning on doing already. And so he refills up his cash value there to 154,000. Now, as an example here, I didn't show him borrowing that. Again, technically you could. You pay it back, you can borrow it right back out of there. They have an opportunity, but just to show the numbers a little better, let's say he waits till the next year. Next year, his cash value is built up much more than that. He pays another 50. And in that year, he decides, you know what, I'm going to get 25 golf carts, pays 112,500. His total loan balance then is 118,000. But he knows, hey, at that amount, I can actually go out and make a good amount more. And so he doesn't just pay back the 112,000, he pays back much more than that into the policy there. And so if you look at that 25 times 6,500, made about 162,500, also paid back the interest there. So there is some cost to the interest, but those are pretty good profit margins for what you're doing. Now we're also projecting this out. Will some of them sell for less? Yes, and different things like that. But this gives you an idea of the possibilities for anything in business or real estate or crypto or whatever it is that you want to invest in. It shows the flexibility, because I know a lot of times things that will work if you don't have a structured payment there. Things I've had clients use it for syndications. Maybe that syndication isn't cash flowing, but there's going to be a big payout at the end. They want to be able to leverage that and be able to then, once a big payout comes, be able to pay it all back. Now, is there interest that's built up there? Absolutely. Should you plan on borrowing from the policy and never ever paying back the loans? Absolutely not. That's not what I'm saying there. But the flexibility, the option is a great thing, specifically in this situation and many other situations as well. Now, best case, you are paying off the interest every single year, because that's going to keep it from compounding year over year against you, and having a plan to pay it back. And that's what's the case with all of these people I'm talking about that are investing. There's a plan to pay it back. It's not a, hey, I'm going to do this and then hope that I get enough money to pay it back. But if not, we're just never going to pay it back and let the loan compound. So that's definitely not what I'm advocating for. But in this case, he does pay it back. He pays it back plus some, pays the $50,000. And now all of a sudden at that point, even if he did nothing else with the policy besides continue funding it like he was planning to, that's now $268,000 of cash value with the extra growth from, hey, we got it, we paid it back, we got it, we paid it back, paid off the interest there, and all of that stuff that now enabled him in those 2 years. He didn't have to fund 50 out of pocket. He funded it from the investments, kept that money, and can do whatever he wants with it, can travel with it, can do different things because he's now using this. A lot of times you can use this in its own ecosystem. If you are someone like this, where I'm going to use my money to invest, I'm going to use that to help pay part of the premiums. And then over time, that's going to keep growing and compounding. I'm going to have enough cash flow from whatever investments I'm doing to fund those premiums. And that can just keep on building and building, especially over, I mean, we showed 4 years. Say he did this for that 10 years if he wanted to and can do it like that. So again, that's a quick example of just the possibilities there of the flexibility of a policy and what it could look like. And then also at the end of the day, too, continues funding that, wants to stop funding at age 61. At that point, he really wanted about $500,000 of cash value just to have liquid on hand to help kind of go with his other investments and other portfolio. And also wanted a growing death benefit. So he continues to get that. If we just zoom out to age 85, kind of life expectancy, that's now $2.6 million that can go out, as well as $2.2 million of cash value that's available. Hey, 85 years old, he wants to buy some more golf carts. He can do that. Now, will he do that? Probably not at that point. It's more of a we're leaving it to the family or can help out in retirement as a volatility buffer, any of the other stuff that we talk about. So again, quick example there. Hope that's helpful to see some of the possibilities there that maybe you hadn't thought of in a policy. We talk about using it for investing, but can give some examples of, hey, what are people actually doing with a policy? What are we here at BetterWealth doing with the policy? And some examples to give you ideas exactly how you might be able to use it. So until next time, see you. Hey everyone, it's Justin Gartman, a wealth coach here at BetterWealth. And if you are a high earning professional, an entrepreneur, or someone who just wants more control over your money, we are offering something called a clarity call. It's a one on one conversation with someone like myself where we are able to walk you through exactly how overfunded whole life insurance could help you build a safe, liquid, tax advantage foundation for your wealth. No pressure or fluff, just real clarity on whether this strategy is right for you. So click the link in the description below or tagged comment and we'll walk you through exactly how we can possibly help you.